Welcome everyone. In this video, we will discuss the basics of accounting, something like recording business transactions, classifying business transactions, and summarizing business transactions. So that is journal, ledgers, and trial balance. So let's get started. Journal, recording business transaction through journal is the very basic state of accounting cycle. So, recording journal through journal is the primary steps, recording in the primary books of accounts. So before we process, we need to understand and learn some basic terms. So in the previous video, if you didn't watch, so look at the previous video, watch that, and then so that's the fundamentals of accounting, introduction to accounting. So you will understand what is asset, liabilities, revenues, expenses, and what is accounting, how it works. I have explained these in the previous clip. So in this clip, we will say accounting equation, what are the accounts related to this, what is debit, what is credit, how the accounting transactions are recorded in the books, that is journal entries, and then how to classify the transaction through ledgers, and how to summarize the transactions, that is how to prepare the trial balance from the T accounts. So the basic step, as I mentioned, is the journal entry, recording the transaction in the primary books of accounts. So the journal, what is journal? Journal is a chronological records of transaction. So when the transaction happens, immediately after happening the transaction, we should record it in the books of accounts according to the chronology of the incidents. So that is recording in the primary books. The second step is after these records. So these records are permanently transferred or classified or record after classifying under different heads of accounts, after different classes, classifying them into different classes. This is what we called classifying the transaction through ledgers, or classifying them under different names, different assets, different liabilities, different expenses, something like this. Yeah, these are what we call the ledgers. And as we know, this is the basic concept of accounting. Then each and every transaction should have two sides. One is the debit side, the other one is the credit side. So, and the two sides are equal. Okay, should be equal. So after recording the transaction in two sides of a particular account, what is the balance? What is the difference? The difference is the balance, actually. The total of debit and total of credit. And then, so what differs? What the amount differs between this is the balance. So, for example, in the cash account, you have a cash account. You start with something at the beginning, right? And then you receive money coming out, right? Cash coming in, all together is recorded in the, all these are recorded in the debit side, and all the cash payments are going out from the organization, recorded on the credit side, okay? Credit column. And then what came in and what went out may not be equal, and it shouldn't be, usually is not equal. So what is the difference? Is the ending cash balance, ending balance. Similarly, is the case for other accounts as well. So what is the balance? That the balance of each account, like cash account, furniture account, purchase account, sales account, are transferred to the summary statements. And this summary statement, what we call is the trial balance, right? the trials, okay, whether the records, what we did, primary records, permanent records, right, are accurate or not. So in this process, so firstly is the recording transaction through journal, copy them to the ledger, and then prepare trial balance. This is the these are the three basic steps of accounting cycle. So let's start with how to record. So in case of recording, what are the activities we have to do? So we identified here four basic activity, right, for recording an incident, a transaction in the books of accounts, in journal. Okay, so the first step is identify the transaction from the source documents, identifying the transaction, identifying that there is something happened in the organization, right? Any monetary transaction, any monetary events, incident happened in the organization, right? That's the transaction. We have to identify it from a source document. What is source documents? If you purchase something, you should have a receipt, invoice. If you sell something, you should have a documents, a receipts, right? As a note, right? If you travel, right, you want to pay, so you should pay something, a fares, right? Airfare, bus fares, okay? So you should have a receipt, a documents, a proof that the transaction happened. Without any evidence, without any receipt, without any source document, it's not valid, it's not right to record anything in the books of account. This is what we shouldn't do. Number two, specify the accounts affected by the transaction. What are the accounts involved, right, in that particular transaction? A transaction must have at least two accounts. It may be, there may have three accounts, four accounts, five accounts involved in a transaction, right? As many people or parties or accounts involved, so yeah, those are the parties or the accounts affected by the accounts. Okay, so we need to identify what are the accounts involved, what are the accounts affected by this transaction, and then determine whether these accounts are increasing or decreasing. Okay, we identify a particular account, say cash account is involved, so cash is increasing or decreasing. We need to identify that. And if it, and then the next step, if it increase, and cash is an asset account, if it increase, then what should happen? Asset account increase should be debited. Or if it decrease, asset decrease should be credited, right? And then if we know this, based on these rules, right, we have to record a particular transaction or the transactions of the organization in the books of accounts. All right. So let's see what we can do for a particular account. Okay. So think of a transaction, any transaction. Okay, any transaction. This is the first thing. You need to assume a transaction, and then you need to identify what are the accounts involved. At least two accounts should be involved, right? And then how, what is the format, structure of your records? Okay, so there should have a date and the details of the transactions, right? And the accounts involved, one is in the debit side, debit amount, and the other account should be recorded in the credit side, this is the credit amount, and it should have a description why we are recording this transaction. So an accountant is here now, but he not be here after certain time, after next year or 5 years after. So if auditors comes, if any justification, if we need to check why we have recorded this, why we did this transaction, we recorded this transaction in the books of accounts, we should, or anyone should be able to understand what is the reason of this transaction. So this is actually a reason, right? You have to record it. So we purchased something for cash, and that's why we recorded it. We purchased on account, that's why we recorded it. Okay, whatever, we should put a small note under each transaction. So this is the process. This is the process how we should record. Okay, so as we said, two sides. One is the debit side and the other one is the credit side. In short, we write DR, the debit side, usually the left-hand column, left-hand side, and the credit or the CR is usually we write in the credit column, credit side. You can look at the YouTube video even for details further. So debit and credit and double entry accounting system. As we said, double entry, right? So double entry means each and every accounting events. Each and every event should have two parties involved, right? At least two parties, at least two accounts. Two accounts are affected, two sides are affected, right? Because of a particular incident. And this is being this is the basic rule in double entry accounting system. If I give some money, obviously there should have someone who is receiving it, right? If I receive some money, that means obviously someone is giving it to me. So this is the fundamentals of double entry accounting system invented by Luca Pacioli. So yeah, so we need to identify the accounts involved, and we need to identify how these accounts are impacted, and if the account is increased or decreased, whether it should be debited or credited. And obviously it depends on the nature of the accounts. So let's see the nature, which account should be debited and which account should be credited because of increase or decrease. So there are different kinds of accounts, right? An account can be, there are lots of accounts, can be revenue accounts, many accounts can be expense accounts, right? Assets account, liabilities account, owner's equity account. So whatever the accounts, whatever the element related to a particular transaction should be any of these classes, right? So if we purchase something, so purchase and we paid cash, that means purchase is an expense account and cash is an asset account. If we sell something, right, or provide services, so service providing, so we are earning revenues and we receive money is cash, right? If it is cash account, so it is an asset account, right? So something like this. So we borrowed some money from bank, is loan account. We received money, cash account, and we borrowed, we have to pay in future, that is a liability account. Okay, we have to pay in future. So as I mentioned before, so what is revenue, what is expense, what is asset, liability, owner's equity? In the previous video, you can just watch it and then know in details. So if the account is a revenue account, so if revenue account increases because of a transaction, then it should be revenue account, or that particular account, say rent revenue, insurance revenue, or insurance, say rent revenue or commission revenue or dividend revenue or sales revenue, service revenue. If it increases, should be credited. If decreases for any events, for any incident, for any cause, for any reason, right, that should be debited. Expense account, any expense account, interest expense, insurance expense, rent expense, right, salaries expense, wages expense, depreciation expense, whatever, any expense account, if increases, should be debited. In the journal entry, we should record it in the debit side. And if it decreases for any reason, should be credited. Asset account, any assets account, can be furniture account, machinery account, cash account, right, computers or utensils, right, stationaries, right, whatever the assets, building account, land account. So if any asset we purchase, if any asset increases in the organization, should be debited. If asset decreases for any reason, should be credited. Liabilities, right? So as we defined before, obligations of the organization, if increases, if our obligation increase, if we purchase more on account or credit, right, on credit, right, then it increase, liability increase. If we borrowed money, if we get loans, so liability increases. If it increase, credit. If decreases, if we repaid the loan, right, So if we paid our creditors, so liability decreases, that means it should be debited in the journal entry. Owner's equity, as we said, the owners contributed to the business, contribution or capital, right? Owners invested in the business, right? Internal liability, this is a kind of liability and the same role as liabilities, right? Owner's equity, owners invested more in the business, so increases credit, decreases debit. All right. So this is the basic role or modern role that we need to kind of memorize, kind of understand, right? First, before we proceed for recording any transaction in the books of accounts. All right. Some examples you can say, yeah, an asset increases and asset decreases. If we purchase, as we said, purchase a purchase motor vehicle for cash, right? So motor vehicle account debit, right? Motor vehicle came in, motor vehicle is an asset account increase is debited, right? And cash account, cash is also an asset account, but cash decrease because you paid, right? Organization paid cash for purchasing motor vehicle. So cash is credited. So asset decrease, cash decrease. Okay. So what if we paid rent for, if we paid rent, right, for cash, we paid rent for cash. What happened? Rent expense debit. Rent is an expense. We have to run the business, right? For running the business, we have to pay rent. So whatever we spend for running a business, to operate the business, right, is the rent expense and cash account credit. All right, because we paid cash and cash decrease. So rent expense, expense increase, debit, and cash decrease, credit. Okay. All right. So how we can transfer the transactions that we recorded in the journal account, journal entry, to the ledgers? How we can classify the transaction, right? So there's classification, the second stage. So the classification, right? All the related transaction of a particular account, particular element should be recorded, should be classified under a particular ledger, right? So we have hundreds of thousands of cash transactions. We have many transactions we recorded, events, incident happened relating to furniture, relating to account receivable, relating to accounts payable, relating to capital. So we have to classify them under different heads. So all the cash accounts, right? All the cash transactions should be come under one classification, cash account. All the bank transactions should be recorded under bank account. All the furniture related transactions, increase and decrease, should be recorded under furniture account. So yeah, this is what is the ledger. This is how we classify the transaction under a head. So in case of recording the ledger or in case of transferring the transaction to the ledger, so there are two different ways you can do it. So one is the traditional form, that is the T account, right? It's a T, okay? And then, yeah, so it's a T. So is the name of the account, it should be here, the dates, details, and the debit amounts, the date, details, and credit accounts. But you may have different columns, so can be journal number, which journal it is coming from, and the journal folio, which books it's coming from. And the same in the journal books, we can record another column as well, like ledger, which ledger it is going to. Another format, or the modern format, or whatever current format is used, something like this as well. Name of the accounts, and then date, details, debit amount, credit amount, balance amount. So you don't need to record two sides. So debit amount, all the details are here, dates are here, details are here, and the debit, if the account is debited, then it should be in the debit side. It's credited in the credit side. And then after adjusting debit and credit, what's the balance? So this is what is called a continuous form. So in this case, after each and every transaction, you will know what's the balance of this particular account. Yeah. After every transaction, you will see the balance. But here, you will find the balance at the end. When you find the difference between the debit side and the credit side, then you will find the balance. But here, you will calculate the balance after every transaction. So you recorded something here, and then say it is debited, and then another one you recorded in the credit side. What's the difference between debit and credit? You should record the balance here. Okay, what's the debit? You should record it. This is the balance. If you recorded something on the credit, what's the difference between debit and credit? Should be coming here. So after every transaction, you will record either the balance will increase or decrease, but you will know a balance after every transaction, right? So, for example, this is a journal entry. How you should transfer it to the ledger account. So this came in the debit side, and that is the cash account, asset increase, debit side, capital account, credit side. That means the owners invested in the business. The owners invested in the business. So what happens? Business got some cash from the owner, cash increase, and also this is a liability for the business. Why? Capital is liability. Why? Some people say, why capital is liability? Right? The people usually who are not familiar in the business or in accounting. So capital is a liability for the business. Why? Because organization and the owners are separate entity. The owner got the money from the business got the money from the owners. So at the end of after certain time, or whenever the owner wants, owner can get the money back. So these are the money invested by the owner. If owners wants, owner can get the money back because these are the claims of the owners. So the business got the money from the owners as a liability, as a borrowings, right? These are actually the money of the owners. So whenever owners wants, business should repay them. This is the obligation of the business to pay. All right, that's why this is a liability account and capital, because owners invested more money or owners invested some money, so capital increase. So capital increase, owner's equity increase, credit, cash increase or asset account increase, debit. This is the journal entry. How we should post it to the ledger account. So so this is cash account is debit, so it should go to the cash account, and it is capital account, owner's equity account, it should go to owner's equity account. So cash debited, so that this cash amount will go to the debit side of cash. Okay, cash debit should go to the debit side of the cash account, and capital account is credited. So in the capital account, right, owner's account, owner's equity account, it should go to the credit side of the ledger. Okay, so this is how we should transfer all the transactions, whatever the transactions happen, right? So as we mentioned before, many hundreds of transactions happen relating to cash. So all the cash receipts, right? Cash account, as we said, increase debit. So if it is a beginning balance, it should come on the debit side. All the asset account will have a debit balance. All the liability accounts will have a credit balance. Okay, owner's equity, credit balance. Expense account, debit balance. And increase, again debit. Decrease, right, will go to the other side, opposite side. Cash, decrease, credit side. All increase, debit side. And after that, at the end of each and every year or accounting period, you will find a balance. What's the total of the credit and what's the total of the debit? Okay, and see, this is, and cash account will always have a debit balance, right? Will always have a debit balance. Cash account will never has a credit balance, because how much you receive, you can't give more. So credit cannot be higher than debits. So accounts receivable, you can see here, total debit 3,000, credit 1,000. What's the difference? So 2,000 is higher or more on the debit side. So this is debit balance 2,000. Supplies debited only 500, nothing credited. So 500 minus 0 is 500. So this is how we should firstly transfer all the journal entries to the ledgers, to the accounts, and then find out the balance, okay, at the end of the period. And these balances will be transferred to the summary statement that we said, trial balance. Okay, trial balance, and we see whether the records are what we made are correctly recorded or not. A trial balance, yeah, is actually the list of the balances of the ledgers. Is a list of the balances of the ledgers. All the debit balances are transferred on the debit side. All the credit balances are transferred on the credit side. And if we did everything right, okay, so the total of debits and total of credits should be equal. It should be equal, right? So if everything is right, so it should be equal and should be okay. But if both sides doesn't agree with each other, that is a problem. That means there is a mistake. We made some mistake, and we uh, we have to identify the problems, right? Even though sometimes both side is equal, but there may have some problem, right? So we have to record something as asset account, like we purchase furniture, but we record it under machinery. We purchase machinery, we record it as furniture, right? So the debit and credit would be the same, but yeah, instead of furniture account would be higher or lower, or machinery account would be higher or lower. Okay, so there are some reasons that actually doesn't impact the balancing of the trial balance. But there are some incidents, some incident can happen that actually the trial balance can actually check. All right. So this is how what it will look like. Okay, if you transfer all the balance from say cash account, it was cash debit balance, account receivable debit balance, office supplies debit balance. So all the debit balances on the debit side recorded on the debit balance on the debit side, all the credit balances, right, owner's equity, accounts payable, right, service revenues are recorded on the credit side, credit balances, and then you can see both sides agree with each other, right? So correcting the errors, if you find anything um, abnormal, doesn't balance, right? So we have to find out which account we didn't record, what is missing, right? And there are some tricks given here. If you say, so divide the difference between debit and credit by 2, right? A debit treated as a credit, or a credit treated as a debit, double the amount of the errors, right? If 200 debit has been credited, right, so the difference will be 400. So if you something like this, if you divide the 400 by 2 and then see it is 200, and then see which 200 you didn't record, something like this, you can find this way. Yeah, if the difference between debits and credit divisible by 9, yeah, then yeah, it can be slide error, 500 instead of 50, or 50 instead of 500, or 109 instead of 10.90, something like this. Or it can be a transposing error. It can be 89 instead of 98, or 98 instead of 99. So you can see whether anything similar happened. Is there any transaction like 89, or is there any transaction like 98? Then you can see easy way to find out this. Let's see so this is how we should do journal, and then transfer to the ledger, and then we should prepare the trial balance. Okay, so let's now see some advanced or kind of trickier journal entries. When we sell inventory, right, when we sell some products or goods to the people, to the customers, how many accounts are affected? How many accounts are there? There are five. Five accounts can be impacted because of a transaction, something like this. Okay, so you can see most sales of Australia are made on credit. Now let's assume that Smart Touch made 5,500 sale on credit. All right, including GST. Right, GST is a kind of VAT, value added tax in some countries, and the terms is N and 10, that means and no discount is offered, right? The credit period is 10 days. So you sell on account, right? And the credit period is 10 days. For a goods cost 2,900 net of GST, without GST, without VAT. The entries should be recorded on sales and cost of sales as follows. How we should record it in the books of accounts. So if you sell on account, you didn't receive money, right? So you will receive, you didn't receive, but you will receive in future. So what if we receive in future is receivable, accounts receivable. So account receivable will increase because of credit sales. All right, so asset, account receivable is an asset account because this is our claim on someone. Someone will pay this amount in future to us. So we will get the benefit in future. Okay, account receivable debit and sales revenue credit. Okay, sales revenue credit. Okay, so how much is the sales? So this is 5,500, right, including GST. Okay, so GST, so 10% is added here. So without 10%, how much is the sales revenue? Is 5,000, and 10% of this is 500 is the GST. Okay, yeah. So these are the three accounts related to the sales. But what is the products of the goods that we sold? The cost of those goods in our books of account is the cost goods that we sold is actually 2,900. The goods that we provided to the customer. So our goods actually decreased in our warehouse, in our stock. So we need to record that as well. So the cost of sales 2,900 and the inventory, the decrease, asset decrease is 2,900. The cost of goods, cost of sales or cost of goods sold is expense increase, and inventory asset decrease 2,900. So 5 accounts are related to this particular transaction. Okay, so another tricky transaction. So let's see, sales discounts. All right, so on 17th of July, the last day of the discount period, suppose that Greg Tunes collects 4,500 of receivable. Assume that the business allows customers to take discounts on all amounts Greg Tunes receives within discount period. So if customer gives you within discount period, they will get discounts. So the business's cash receives 4,312. Right? So how they receive this money is actually 2% discount, right? So after deducting 2% of discount, that means total amount, the claim, right, was 4,400, but 2% discount, that is 88 deducted from here. That means ultimately 4,312 has been received. So how you will record this? Money receipts. So cash receipts, debit, cash increase. Sales discount is a loss of the organization, is an expenditure. You give discount to your customer. So you are not receiving some money. That's your loss. It's an expense, right? So it should be expense increase should be debited, right? So 80, right, is the real discount, and out of which obviously out of 88, 80 is the real discount, and 8 is actually GST, right? You are losing 88, but the full amount is not yours, right? 88 discount and 10% of 88, 10% of 80 is actually the sales amount out, and 10% is 8. So 8 is the loss of government's money, that is GST, VAT. So you are giving discount to your customer 88, and you are losing 80, and government is losing 8. So total, so GST was actually credited. Remember, in the previous transaction, you can say GST credited, but when you receiving money or not receiving money, GST is debited. All right, and account receivable 4,400. All right, account receivable decrease because customer paid some money, right? So if they paid, they are not supposed to pay anything in future, right? So account receivable means they will give us in future. If it increases, it's an asset account, right? If we have more claim, if we expect to receive in future, increase. But if they give money, account receivable, now decrease. Our claim will reduce. Okay. So asset account decrease, credited, right? Cash asset account increase, debited, right? Discount is a loss expense, is debited. GST loss or are not receiving is debited. All right. Yeah. So the summary of these discussions today is actually we need to learn what is asset, liabilities, owners equities, revenues, expenses, and what is journal, ledger, trial balance, how we should actually record this, how debit is determined, credit is determined, yeah, and basically these rules, modern rules of debiting and crediting the transactions in the books of accounts. Yeah, so this was kind of this chapter. Thank you very much for watching, and let me know by commenting in the video if I can help you, if by making any other video, and share with your friends, and the teachers, please share with your students if these are helpful to the people. Thank you very much. I'll see you in another video.